You have $50,000 sitting in a savings account, waiting for the stock market to crash so you can buy the dip. It feels like a smart, safe move. But by the end of this video, you're going to see the invisible math that proves this exact strategy is quietly draining more money from your future than any market crash ever could. It's called cash drag, and it is quietly destroying millennial wealth. We've all been there. You read the headlines. The market is at an all-time high. Experts are predicting a recession, and you think, I'll just wait. I'll keep my money in cash until things get cheaper. It feels incredibly responsible. You feel like a wolf on the prowl, waiting for the perfect moment to strike. But here is the brutal reality. While you are waiting, the market doesn't care about your feelings. Historically, the stock market goes up about 10% a year on average. If your money is sitting in cash, you are missing out on that growth. But it gets worse. Because cash doesn't just sit there doing nothing. It actually loses value every single day. This is the core of cash drag. Let's say inflation is around 3%. If your high-yield savings account pays you 4%, you might think you're winning. But after taxes on that interest, your real return is basically zero. Meanwhile, if you had invested that same money in a simple S&P 500 index fund, it historically returns about 10%. That difference between 0 and 10%, that gap is the cash drag. It's the invisible weight pulling your net worth backward while you wait for a crash that might not happen for years. And let me ask you this. What happens if the market actually drops tomorrow? Are you actually going to buy? Most people don't, because when the market crashes, fear takes over, and they hold on to their cash even tighter. Let's talk about the myth of the perfect entry point. Imagine you had perfect timing. You bought at the absolute bottom of the 2008 financial crisis. That's amazing, right? You'd be rich. But what if I told you that someone who invested a set amount every single month, even at the absolute worst possible times, still ended up with more money over 30 years than someone who held cash trying to time the dips? There is a famous stat in investing. If you missed just the 10 best days in the market over a 20-year period, your overall returns were cut in half. Half! And here is the absolute kicker. 6 of the 10 best days usually happen within 2 weeks of the 10 worst days. If you are in cash, waiting for the crash, you completely miss the rebound. Let's put real numbers to this. Let's say you have $20,000 sitting on the sidelines. You're waiting for a crash. You wait 1 year. The market goes up 15%. You just missed out on $3,000 in growth. You wait 3 years. The market goes up 30% total. You missed out on $6,000. Now, factor in inflation eating away at your 20 grand during those 3 years. You are drastically poorer than if you had just invested blindly on day one. Investing isn't about predicting the future. It's about managing risk over time. The longer your money is in the market, the lower your risk of losing it. So what do? You stop trying to predict the market, and you use dollar-cost averaging. It means investing a set amount of money on a regular schedule, no matter what the market is doing. Market is at an all-time high. You invest. Market is crashing. You invest. You treat it like a subscription. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. It naturally balances out the volatility. If you are terrified of putting all your money in at once, take that pile of cash and break it up into 6 chunks. Invest 1 chunk every month for the next 6 months. Get the money moving. Because the absolute worst thing you can do with your money is nothing. The fear of losing money in a crash is real. But the math shows us that the slow, invisible bleed of cash drag is a much bigger threat to your financial future. Stop waiting for the perfect crash. It might never come, and you'll be left behind. If this video was helpful, there's more on the channel.